Today we will discuss about a topic called Standing Deposit Facility, which is introduced by Reserve Bank of India (RBI). Here, this is an instrument for money control or money supply by the Reserve Bank of India. So this is a current affair which is coming in Indian economy. So we shall deal with the topic in detail. What is SDF? What is Standing Deposit Facility? The Standing Deposit Facility is proposed to be introduced by the RBI. It's a collateral-free liquidity absorption mechanism that aims to absorb liquidity from the commercial banking system. So it is said that it is a collateral-free. That is, there is no need of involvement of government securities that has to be provided by the RBI. Here it is saying that it is an liquidity absorption mechanism. So it is intended to absorb the excess liquidity or money supply in the market. So collateral free is to be noted, and also it is to absorb excess liquidity. Here RBI uses many number of instruments such as cash reserve ratio, open market operations, etc. to absorb excess liquidity or money in the economy. But what happened is that here there is a situation that RBI has run out of these government securities to provide as collateral. So in order to find a solution, RBI has introduced this SDF, which means there is no collateral involved in this particular instrument for RBI. One important fact to be noted is that who has proposed this Standing Deposit Facility scheme? The Standing Deposit Facility scheme has been proposed by Urjit Patel Committee in 2014, which is a very important fact to be remembered. So what is the significance of SDF? The importance of SDF is that it is designed to enable Reserve Bank of India to deal with extraordinary situations in which it has to absorb massive amounts of liquidity. When there is a financial crisis or when there is a high level of money supply in the market, it helps the RBI. SDF helps the RBI to absorb excess liquidity by absorbing the excess amount of money that is circulating in the market through the help of or with the help of Standing Deposit Facility scheme. We may have a doubt that what is the significance of reverse repo, or when there is a reverse repo mechanism there, then what is the need of SDF? What is reverse repo? The rate at which RBI borrows money from commercial banks with an interest rate, that is called a reverse repo. That is, a rate would be provided in which the scheduled commercial banks will deposit or park funds and they will get an interest rate. That is called reverse repo. Here, there should be a collateral from the RBI. RBI should provide a government security to commercial banks when they are accepting funds in reverse repo mechanism. So we have already discussed that there is a shortfall or there is a lack of government securities with the RBI. This inconvenience with the arrangement is that the RBI has to provide securities every time when banks provide funds. This inconvenience or this problem is rectified in Standing Deposit Facility, where there is no involvement of collateral, which is very important point. Once again, we are dealing with the same point. The Standing Deposit Facility is a collateral free arrangement, meaning that RBI need not give any collateral for liquidity absorption. The SDF will allow the RBI to suck out liquidity without offering government securities as collateral. So we have mentioned earlier that there is an inconvenience that RBI does not possess enough amount of government security to provide to the scheduled commercial banks when they accept funds in reverse repo rate mechanism. Now that has been solved because Standing Deposit Facility does not require involvement of a collateral. This is a very important point again. Within the existing liquidity management framework, liquidity absorption through reverse repo, open market operation and cash reserve ratio are the discretion of the Reserve Bank. On the other hand, the Standing Deposit Facility would be at the discretion of banks. Banks has the discretion to decide. So this is a very important point to be remembered. In this class, we have discussed about what is Standing Deposit Facility. It is the facility by which the RBI absorbs excess liquidity from the economy without the help of a collateral, without giving collateral to the scheduled commercial banks in the country. So this is also a quantitative mechanism to absorb excess money from the market. Thank you for watching the video. Please like, subscribe and comment if you like the video.